After you watch this video, I dare you to tell me stock prices aren't going to crash soon. I dare you. I dare you. This is the Shiller PE ratio. It essentially shows how expensive stock prices are generally, the whole S&P 500. Right here you can see this was 1929, the peak before the Great Depression, before an 89% stock price decline. The Shiller PE ratio at the time was about 30. Right now, we're at 31. Now, it's not as high as it was in 2000, the dot-com bubble, but that was very concentrated to tech stocks. Right now, we're broadly overpriced. Real estate, stocks, and bonds, we're overpriced. So you can just look at this right here. I'm sure you are aware of this. It is very hard for people to afford houses right now. And this shows it right here. It's really clear. Housing is the most unaffordable it's been since, at least as far as this data goes back, since 1947. It's pretty crazy. This was the housing bubble of 2006, 2007, when home prices went crazy. It's more unaffordable now than it was then. My grandpa was telling me when he bought his house in right around here, 1970, he was saying, you know, at that time, if you had a job, you just bought a house, no problem. It's not the same thing today. It is entirely different. It's basically the opposite. It's so hard for people to afford houses. So this takes the median home price, and it divides it by the median income. So you can just tell it's very unaffordable right now. So another thing to look at is mortgage rates. They were recently at 2 or 3%. Now they're about 8%. But what's interesting is home prices haven't really come down much yet. Why do you think that is? I have an idea. Most people are locked into 30-year mortgages at low interest rates. So if somebody wants to sell their property for $500,000 and move next door, buy one for $500,000, their monthly payment would go way up, okay? Because they would have to forfeit their 2 to 3% mortgage rate and get one for about 8%. So I think people aren't wanting to sell their houses because they're going to have to pay a higher mortgage rate. So the reason why real estate prices haven't come down yet is because the supply isn't there. The demand isn't there. People aren't really able to afford these prices. But on the other hand, people aren't really selling. So there isn't that volume yet. But as people have to move out, they have to go to another part of the country. There's divorces, there are deaths, unfortunately. Over time, people will have to sell, and they'll be on the market, and people just can't afford them, so the prices have to come down. They haven't come down yet, but I think they will come down soon. Look at this. This is the yield curve. So if you buy a bond, you're essentially lending money to the government. And this shows you the different maturities. You can do a 1 month T-bill is what it's called. You loan your money to the government for a month and you can get a return. You'd get an annualized return of about 5.5%. You can do it for 2 months, 3, 4, and beyond. You can go all the way to 30 years, okay? I don't know if you noticed this, but something seems a little off, right? Okay, this is updated for today. The yields are a little bit higher. Right here, something seems a little bit off. These short-term treasuries, they have higher yields than the 30-year, than the 10-year, the 20-year, the 30-year. That's weird. That's abnormal. That's actually one of the strongest indicators of an upcoming recession. It's called an inverted yield curve. Normally, you'd have the short-term rates down here and the long-term rates up here. But it's backwards. It's backwards. You can see this in a different way. This takes the 10-year bond and it subtracts the 2-year bond. Okay? So this horizontal black line it shows 0. Anytime it is below that, that means the yield curve was inverted. So we can see how that looks historically. Also note that these vertical gray bars, these show recessions. Here, 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 here. Okay? So you can see it inverts, and then it starts to uninvert, and then a recession. Here again, invert, it starts to uninvert, recession, invert, uninvert, recession. And again, here and here. It happened here, especially if you look at the 3-month versus 10-year bond. There's different ways of looking at it. It happens here, and it was a very brief recession. What happened was the Fed, they didn't allow it really to happen, to have a deep recession. They swooped in and printed a lot of money. I'll show you that in a little bit. So right now, we are inverted. We're deeply inverted. And I think as soon as we'll probably start to uninvert, meaning these rates will probably come down, these might go up a little bit, it'll start to uninvert, and then we will probably have a recession. So right here, the Fed didn't really allow a recession to happen. What they did was right here. Look at this stat. It's mind-blowing. About 80% of all of the US dollars in existence were printed in the last 22 months. Did you hear that? About 80% of all of the US dollars in existence were printed in a span of 22 months, from January 2020 to October 2022. When you had all of the US dollars in circulation went from 4 trillion to 20 trillion. Just like that. And you might think that is not a big deal, right? It's just more money. And they were stimulus checks. People got money. They were happy. Great, right? It's not so great. It is a short-term fix to a long-term problem. The government has a lot of debt. Look at this. The government has a lot of debt here. About $32.8 trillion. Okay? That's a big number. And the interest they're paying on this debt is right here, about $673 billion. What's interesting is projected in a few years, it's estimated that the government will be paying more interest on their debt than they would be receiving in income tax. How does that work? Imagine if you took out a huge loan, right? You took out a huge loan, and the interest you're paying on that loan is more than the amount of money you're receiving from your job, all of your income. So your interest payments are more than your income. How does that work? That's not going to work. Something has to snap. Something has to break. Something is out of whack. I think we're going to see something pretty soon here. So there's just too much debt. So what happens when you increase the money supply like that? What happens is inflation. That's what happens. The government, they'll try to be confusing. They'll try to blame inflation on a bunch of different things. When you increase the money supply, when you increase the money supply without increasing the supply of goods and services, you have inflation. Because simply put, if you understand supply and demand, they are increasing the demand of goods and services without increasing the supply of goods and services. The way they're increasing the demand is by printing more money. So people have more money to spend. They have more money to buy groceries, cars, gas. That's why everything is so expensive. It's so hard to afford anything these days. Try to buy a house, good luck. Rent is crazy. Gas is crazy. All these prices are crazy. So what do they do to try to combat inflation? What the Federal Reserve is supposed to do, they are supposed to raise interest rates. This is a federal funds rate right here. This shows historically the generally the interest rates that the banks will have to borrow at. So this will have generally an effect on mortgage rates, on other things, credit card rates. Not a direct effect, but kind of indirect. So if you see this historically here, it's pretty cyclical. You'll have these rate hiking cycles like this one. It goes up, 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 up. It plateaus, okay? And this is right about when the Fed will sense a recession coming. Unemployment rate starts creeping up, GDP, starts softening up, and then they start cutting rates. But then you have a recession. They continue dropping rates, and a recession deepens. Because there's generally a lag effect with these interest rate declines. I think most people are thinking another 2020 is going to happen, where they drop rates, they start printing money, and stocks to the moon. I don't think so. People are thinking about a soft landing. That's what you hear all the time. Soft landing, right? That the idea that the Fed is going to raise rates just enough to bring down inflation back to 2 or 3%, and then if we're close to recession, they can lower interest rates and they can just thread the needle. That is what they're aiming for. Are they going to accomplish that? I don't think so. I don't think they will. So imagine that scenario, a soft landing. That means asset prices come down maybe just a little bit. Inflation comes down, all fine, right? That doesn't make sense if you're going to have prices come down just a little bit and they just settle right around a Shiller PE ratio of 30 or something, or somewhere up here. It's not just going to settle there. You have high price to earnings ratios for stocks if people assume that there's going to be substantial growth. There's going to be abnormal big growth in the future. But if they think it's going to be stagnant, it has no business being up here. The stock prices are too high. They've got to come down. The median Shiller PE ratio is about 16. Right now we're at like 31. Just simply put, the stock prices can come down like about another 50% from here. And generally it doesn't just stop right at the median. It tends to go below it, especially as interest rates come up. So I can feel you thinking, no, they're going to do a soft landing. It's going to be fine. The difference in 2020 was so this is the CPI, the Consumer Price Index. This shows CPI inflation rate. This shows how much inflation there is essentially. So in 2020, they were sitting on 1.2% inflation. So that's low inflation. So they had more room to lower interest rates and print a ton of money. They overdid it, but they had more room to do it. We're just coming off of really high inflation. And the crazy thing is these CPI numbers, I think, are rigged. They have changed throughout the years. So this CPI here in 2022 is different than in the 70s and 80s. It's a different CPI. They used different calculations. They changed the calculations. So when we had high inflation here in the double digits in the 70s, in the 80s, 13.5%. What we just experienced in 2022 might have been worse than this, because they're trying to make it seem like the inflation isn't as bad as it is. Here's the thing. Let me introduce this concept here. Inflation, it's not this confusing thing that is just, it happens outside of people's control. It is done on purpose by the government. It is a tax. It is a form of taxation. When the government spends money on military, on social security, on big things like that, when they spend anything, they have to pay for it. And traditionally, it comes from income taxes from citizens. That's normally how it goes. But another way, a sneaky way, is inflation. What they do is the Federal Reserve, they will print money out of nowhere and they will buy government bonds. That means you're essentially lending the government money, right? So the government is just borrowing money. When the Fed prints money and buys bonds, you're just increasing the money supply. So you have inflation. So in either case, if the government is going to tax you, it lowers your buying power. If they're going to create inflation, it lowers your buying power. They both do the same things, okay? They're both essentially a tax. However, this inflation, I think, is the worst form of tax. I think this inflation is the worst form of tax because it is a tax on the poor. Inflation is a tax on the poor, okay? Because the rich people, they generally own assets like real estate and stocks. And when inflation happens, those asset prices tend to go up. Therefore, their net worths go up. But the poor, the middle class, they generally don't own as many assets. And their cost of living goes up. You try to go to the grocery store, buy some eggs and milk or whatever. You try to buy some gas. You try to pay for rent. Everything is so expensive. Your buying power goes down. So this inflation is a tax. So you have to keep that in mind. So understand now that the inflation rate may be going down based on this new CPI data. And I'll show you here the shadow stats right here. This shows the different calculations, official versus shadow stats, 1980 based. So we probably peaked around 17, maybe 18% inflation rate. Just recently, 2022. Okay? If you use the same 1980s CPI metrics. Now, this is according to shadow stats. I don't know how accurate this is, but I believe it. I believe it. They change the basket of goods that they measure. They take certain things out. They add certain things. They're like, oh, gas is going up. We're going to remove that. It's too volatile. They just change a bunch of stuff. They want to try to say, no, the CPI, inflation, it's not that bad. So they can continue inflating. They continue diminishing the buying power. It's tax. They're taxing in a sneaky way, and it's the worst form possible. It's a tax on the poor. It's not good. Something has to break. It doesn't make sense. So you have this inflation, and again, it's maybe coming down, but that doesn't mean prices are generally coming down. The rate at which the prices are increasing is slowing. They're still too high. The prices are high. So look, this is the personal savings rate. It shows it from, the late 50s. So 2020, there was a huge spike. That was when the government was printing money and giving stimulus checks. Everyone was happy. It was great, right? It was a short-term fix to a long-term problem. Everybody was all happy. Consumer savings rate was high. It was great, right? That was all-time high by far. And now we're back down to near all-time lows. Everything's expensive. People are running out of savings. Stock prices are high. Home prices are high. The interest rates are going up. What do you think is going to happen? It's cyclical. It's not like it's never going to happen again. It happens. We are long overdue. If you exclude this 2020 flash recession that the Fed didn't allow to happen, if you exclude that, we're long overdue for a recession. Long overdue. And it's just an unfortunate reality of the market cycle. We have recessions. Now, if you play your cards right, if you hold on to some cash, if you can avoid doing things you don't need to do. I know you don't want to hear this, but if you can avoid going out to bars and fancy restaurants, if you're doing that, if you can avoid that right now and save some cash, I think you'd be in a good position in just a few years. I don't know exactly when, but I think soon stock prices will start coming down. See, right here, we just peaked early 2022, late 2021. I think we're going to come down 50, maybe 60% from this peak. It is possible. I know that sounds crazy, but it can go lower than the 2022 lower than the 2020 lows. I know that sounds crazy right now, but there's also no risk premium really. Usually people want a higher yield on stocks versus bonds because bonds are generally safer. There isn't much of that premium right now. Bonds are starting to look pretty attractive. Well, more specifically, the shorter term ones, the T-bills. These are starting to look pretty attractive. 5.5% exempt from state taxes. These are starting to look pretty attractive. So I think there might be a recession coming soon. And yes, that can be unfortunate. Unemployment rate tends to go up in those situations. GDP declines. It's usually a tough time. But if you prepare now, if you prepare before it happens, if you stack up some cash, maybe you buy some T-bills. I'm not a financial advisor. This is just entertainment here. We'll use this as entertainment, all right? If you get some short-term T-bills, it can work out pretty well. If you're just holding on to some cash, I think there are some immense opportunities ahead. It might be raining gold. Raining gold. There, you go outside, raining gold. You want to have some cash to buy assets. You want to have some cash to buy stocks, maybe real estate. And what's interesting is generally in recessions, the interest rates come down, right? In 2008, interest rates went super low and stock prices were low. Real estate prices were low. So it was raining gold. I think it will happen again. You'll have cheap stocks, cheap real estate, and low interest rates. So you can borrow money to buy real estate. Is it raining gold right now? No, it's raining coal. It's not good. Now's not a great time to buy. A lot of people will tell you now's a great time to buy. But look what I just showed you. Everything is so overpriced. I think stock prices will come down in a big way. I think we'll have a recession soon. I think it will be soon, maybe less than 2 years is what I'm thinking. It's hard to pinpoint it exactly, but I think it will be soon. A significant stock price decline. So just be careful. Save your money. I know you don't want to hear it. Save your money and be ready for opportunities ahead.